Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. We're going to run through Twitter, social media, see what people are talking about. It's going to be financial, commodity, or wealth building topics. Those are the topics I like to cover and give my financial opinions about. If you want to follow me, you can follow me at finding_finance, or you can join our community, finding-value.com, to get ideas on individual companies or sectors, and you can see what I'm doing in the markets. We do have a discount going on. Discount is that coupon code, discount. And you get a discount on the first month, and you get a discount on the year if you decide to do a yearly discount. All right, so we got Gary Savage. So savage of him. He says the next test of the top of the multi-month consolidation box should give us a breakout in energy stocks. Lots of upside potential once the breakout occurs. Lots of potential everywhere. Stocks have completed an intermediate degree correction. Energy has likely completed an intermediate degree correction and has happened over and over for years now. Gold completed its intermediate correction with the cartel manufactured bloodbath phase that got retail traders and hedge funds bearish when they should have been bullish. I tried to warn you. This is XLE. This is in a consolidation. As anyone who follows me knows how bullish I am in energy and how we've gone through a consolidation in energy. It's basically one big pennant formation that's broken to the upside. Uranium possesses this same type of characteristic and consolidation as well. We're just waiting for this to break out and change all of our lives, which it will with time. We've got oil prices could rise to $150 a barrel if the conflict between Israel and Hamas escalates. Really, guys, it's going to go to 150 irrespective of this war. That's why we're all looking at these consolidation patterns saying this is just building energy for I think, a monster move to the upside. So it's coming, and it's just dependent on when money starts to flow. It's interest rates that are causing this, not the war. This is all, I think, in my opinion, a reason that people are giving that isn't necessarily the correct reason. This is going to happen irrespective if we go into a war or not. It's based off the debt and the interest rates, how much money is going to come into the system, and the expansionary phase of real estate. It has nothing to do with the conflict. Now, could the conflict pump this thing to the moon? What is the moon? What does that look like? $150 a barrel, that's nothing. Could it go to like $600 a barrel or $700? I don't know. You get an imbalance of a few million barrels a day, where if something like war were to happen in certain regions, it shuts down the Straits of Hormuz. Something happens in a country where they drastically cut production. That's not going to stop at 150, guys. And they were to throw stimulus or QE or money printing, war funding on top of this, you're going to have a whole bunch of credit come out at the same time that supply gets all, I call it dorked up. It gets all jammed up in the system. That imbalance is not going to balance at 150. It's going to balance something with you can move these things maybe $510 or something like that. But that's only if the supply gets all messed up. If the supply stays relatively stable and we just get money printing, I think we're still going to go to a very high level. It just depends on interest rates and how much money printing they really need to do. Demand for silver surged by 18% last year, reaching a record-breaking 1.24 billion ounces and resulting in a significant supply deficit. The Silver Institute forecasts that shortages are likely to continue. So silver demand growing faster than supply, limited organic growth, project delays, and disruptions have held back supply. At least that's what they're telling us from the World Survey 2023, total supply is the blue line, total demand is the white line, and you can see there's a big gap between those two lines, which is your deficit. And yes, I am a major platinum, silver, gold, uranium, natural gas, and oil and coal bull. I'm also a bull in iron ore, copper, steel. I just goes on and on, guys. There's all these deficits that are showing up out in the future of all these different materials. I'm partaking in almost all of them. I don't see a reason why I wouldn't choose the best companies in each of these sectors. A lot of the sectors provide massive upside potential. Uh, 5 baggers, 10 baggers, 20 baggers in each of these sectors, not just one sector. So I know a lot of people, what they try to do is they try to guess which sector is going to be the end all be all best sector. What I do is I spread across all the ones that have traits that could be very big upside potential. They all exhibit in their chart patterns in different sectors accumulation, structural accumulation in the pattern. So I try to spread across wherever that accumulation is structural in the chart pattern, irrespective of the sector. They also have very big fractals, which means that the next move ahead of us could be disgustingly large. And it is the size of some of these patterns, inverted head and shoulders in oil and natural gas companies, the size of the squeezes that are occurring in steel, in some of the iron ore companies, like it's just ridiculous, guys. They're so big. Home buyers have really hit the brakes, causing unseasonal inventory growth. Available inventory of unsold homes rose by 1.8% this week. It's quite clear that home buyers have hit the brakes, waiting to see if mortgage rates recede from these multi-decade highs. The leading indicators for sale prices show that 2023 will end with home price gains of 1 to 2% over 2022. But the 2024 outlook is weakening, and depending on your view of mortgage rates in Q1, whether home prices will appreciate next year. So if we look at the data here, we can go one by one. So this is the total available inventory. It is coming on up, but it's not above 2019 or 2018 or any of those years. It's still very low, but it is trending upward very slowly. We can see this is the home list prices. They are up 439 versus 398 versus that's the median home price versus the median price of new listings. So new listings are actually down a little bit. Sorry, they're down a teeny bit. And then we've got percent of properties with recent price reductions. And there is an increase here with price reductions. So I wanted to share that as well, since we do look at the real estate market. Here's Cuppy. So this is what I talk about asymmetry in investing. He says, "Thanks, buddy. I'm not the pod sort. 2 of the 4 big guys have tried to hire me over the years, and both times I choose to go my own way because of how they make you run tight net. And they can stop you out at any time. Real money is made by finding asymmetry and riding through the volatility. Pods hate that model, the big companies. So that's exactly what I'm doing. I'm finding where the asymmetry is in the market, and then I basically say you got to ride through the volatility. You got to learn the game. You got to go through it and ride through it. That's how you get to the 20, 30 baggers. Cuppy knows what's going on. Totally. Skip those. On risk-adjusted basis, long-term government bonds have been among the worst performing trades in the last 2 years. Now there's a chain reaction of problems from a crowded wrong way positioning only just beginning to surface. Get prepared. September performance and positioning update at Crest Capital. And I think he's talking about the positioning in treasuries and the stock market given interest rates and where interest rates are going. That's my guess. Now, I didn't read through all this, but that's the wrong way positioning. That's where it would be. To continue to focus on real oil story. This is the global observable oil inventory onshore and oil on water. Surplus deficit. There's your deficit. 100 something million barrels. That's our deficit. And you can see the trend. You can even do a nice little move here. It's a consolidation pattern, and then we broke out to the downside. That's when they were releasing some SPR barrels, baby. Try to stop the move, stop the inflation. Gold opening the week at 1966 on the Shanghai Gold Exchange, 2.3% over London OTC. This is kind of weird that we've got different markets trading at different prices. I think we can tell who's trying to do what where, which is the London's trying to keep those prices down. The problem is they don't control Shanghai Gold. So that's going up. They're going down, and you know where the gold's going to go? It's going to go from the lower exchange to the higher exchange. It's going to transfer west to east. Inversions and recessions. I thought this was kind of interesting here. Let me see if this comes up. Evolution of initial unemployment claims after yield curve inversion. So here's today. That's where we're at. And then unemployment generally increases from about where we are today upward for the majority of times in history. As unemployment goes up, that's generally when gold and silver take off for the most part. And then we've got inversions anticipate recessions. Most inverted yield curve since 1980s, but you can see how far we went downward in terms of its inversion. This could still go down and invert much further to the downside. That is very much a possibility. What would cause that? Well, lots of inflation, lots of money printing is going to cause more people to sell bonds. And that could invert even further. Some people think that's going to be the case, that we're going to get a massive inverted yield curve and maybe even a potential problem in the bond markets. And that is where the stimulus QE is going to kick in that I always refer to in some of these clips. I refer to it because I think they're going to have to control or slow down the rate of yield increases due to whatever problems there are in the market. And that's what's going to be the driver of potential QE, or QE is stimulus, not stimulus like handing out checks. It's QE, which is stimulative by its nature, quantitative easing, to print money and buy bonds with it. That's basically, and have the federal balance sheet, the Federal Reserve's balance sheet grow. That's what I mean by that. Copper, Bill Harris, industry expects severe copper shortage globally by 2027, portfolio manager. So that's coming out ahead of us in copper, a severe shortage by 2027. I feel like we're just slowly moving towards a gigantic train wreck. And it's not just, here's something else, guys. I'm just going to speak freely here. It's, all these companies, they are very complex companies making a lot of complex products. If you start to get shortages of silver or copper or any of these, I'll call it well-used commodities in a variety of things, a business from the aspect of the end, like let's say it's the businesses that are using commodities to convert to usable products. Companies like Toyota, Honda, all the aerospace companies like Boeing, Raytheon, Lockheed Martin, like all these different companies, right? All they are businesses, which is a entity that is recognized at the government, and then they fling commodities across their machines and equipment to make usable products. But what if you get a severe shortage of a bunch of different commodities that these guys fling over their equipment to make usable products? Well, what is the value of a company that can't produce their products because of shortages of certain inputs of their commodities? Then all of the value in the world is going to start to transfer to those commodities to solve the problems. And you could have a period of time where you have massive shortages in some of these commodities, where companies are literally fighting over the commodity to run on their, through their equipment and through their manufacturing facilities. That's really the driver of what I think could come. And it's the panic in the industry that needs this stuff. So they could panic and start buying mines in silver. They could panic and start buying, forward production of copper if it's a big enough company. And those are the ones that are going to probably make a bunch of money because that's the only products that'll be out in the market. Their competition, if they don't have the inputs for their outputs in their production facilities, then they're going to be severely at a loss. And then you have to think of what is the pricing on those companies that can't get all the commodities that they need. You know how overpriced they are if they can't get future commodities, and how the markets have these ridiculous price to earnings ratios on all these companies where they think that they're going to have unlimited energy and unlimited commodities. Man, this is going to be one heck of a slap in the face to companies that have not prepared for shortages of certain commodities. And all I can say is I hope they're doing their best. Another thing that you have to think about as well is if there is energy shortages to some degree. I mean, think of how expensive shipping everything around the world is. A lot of these commodities are located where they're located, and you're going to have to ship them all over the place. So the price of the actual commodities could go up massively. So I think the easiest bet would be to look at the physical commodity and own the physical commodity itself to kind of hedge yourself with a big portion of your portfolio. That's the way that I view it. Job openings are dropping like every other recession. This time is different. No, it's not, according to this guy. And this is job openings are coming back down. You can see that in previous areas where there's recessions. Is there going to be a recession? I don't know, guys. I kind of think that there has to be at some point. I just don't know when. Porter nailed this 2008 crisis. I said this weekend, I don't see how the banks can even lend $1 with balance sheets that are full of so much crap. So let's go down and look at his post. Bank credit is now contracting since dollar standard 71. That's only happened once before 2008. Losses in treasury bonds will be far worse than mortgage losses. Stocks are on the verge of a massive collapse. Fractional banking doesn't work in reverse. Few understand this. This is the bank credit, all commercial banks. And what he's saying is that the losses that they have in their bonds, their treasury bonds, is a huge problem. They're bigger losses than the mortgage losses that they had in 2008. This is going to be a really interesting mix. Remember, the banks and the Federal Reserve are all of one entity. This here could be a driver of massive stimulus activity. Anything that's negative is going to result in, my guess, more money printing, more inflation, and it could be aggressive, aggressive inflation. If the mortgage losses are bigger than 2008, there's going to be a lot of stimulus. Now, here's the thing. Those mortgage bonds, the treasury bonds are something that isn't impacted by the real world. So once they refill the coffers in the banks with money, they're going to start loaning again. And I think and there could be lowering of QE to save the banks because of the losses there. So this could get really interesting with this. And I think he's completely right with those losses in treasury bonds at the banks. The consumer is going to feel this. Personal interest payments have surpassed $500 billion. This level has never been seen since 1959 in terms of personal interest payments. So that's pretty crazy. We've got Peru's silver production is currently at the same levels as it was 2 decades ago, excluding the pandemic. Mexico also is experiencing a decline in silver production. So we've got declines in silver production. I talked about this one there. Seriously, would you kindly fix the road I was already taxed to fix? So I'm not causing damage to the car I am taxed annually to drive. which I purchased with the income you already taxed, which sits in the driveway of my home that is highly taxed. Tax, 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 tax. Now, I know some people think that America is low tax. We are not. And then what makes it even worse is the person who bought this car from the company pays corporate taxes, but the company itself does not pay taxes. Their customers do. So the place that this guy bought the car, if he bought it new, also pays taxes, which he paid for. So that's got to be fun there. Why does the government tax gold as capital gains when it is the dishonest devaluation of the fiat dollar, which has stealthily stolen monetary value? Because gold is honest money, it is disliked by dishonest men. The reason that they tax it is because they need to tax everything. They're the ones that are benefiting from it, a lot of these governments. And the governments only have what it takes from others. That's another quote from Ron Paul. What is the worst part about being an engineer? I can tell you what the worst part is. You have to go through a lot of training, a lot of school that is very difficult. The majority of people that become engineers are generally smart. They have higher IQs than those in other sectors or majors. So what is ultimately happening is you get these really bright people that go through very difficult programs that learn the world about the world and how the world works, science and math, and then they get paid absolute crap in comparison to these guys that are running these companies that, in my opinion, isn't as hard. Now, someone would say, well, why don't you just go run the company yourself? Sometimes you just don't want to deal with it. And, and sometimes you can deal with it. It depends on how much money that you make. But in my opinion, engineers are probably the worst paid, smartest individuals out there. Now, some people will say, well, they make $120,000 or 130 or 140 or 150,000 for being an engineer. I am telling you, if you look at the value of a company, the company, there's a few things that really bring value. And what I would like to see is some of the engineers, not all of them, some of them should get paid absorbent amounts of money. They design things that basically can pull a company out of bankruptcy. They can do things that are just incredible. I'm not saying the majority of engineers, I'm just saying some of them. So if I were running a company, I would hire some engineers that do incredible work at very high pay rates. And then everyone else, I probably wouldn't even hire them at all. There's a majority of people that are just dead weight in a lot of these corporations. You can just cut out like half of HR. You can cut out half of these like EHS things because they're just it's governments piling on all this crap. There's a lot of other things like woke, all the wokeness and all that stuff like diversity, equity, inclusion. Could cut that crap all out. There's probably a good 20, 30, 40% of the company that's just dead weight that you can cut. But yeah, that's my opinion there. What item do you prefer buying in person rather than online? And these are just to switch it up from whatever. Well, to buy something in person, if it's something that fits me, like a shirt, that I would probably prefer to do that over something else. But I'll be honest, guys, I buy most everything online for myself, but I don't buy that much stuff in general. So what I do is I'll find the right size. I'll find the right size like shoe, and then I'll buy a bunch of those shoes, and I just keep them. I get them for really cheap prices. Like, and I don't know. I just don't care. I guess. I really hate shopping. Like, I absolutely hate shopping in person. I freaking hate it. I hate parking in the place. I hate walking in, feeling like I'm going to get hit by somebody who's driving a car. A lot of these people, they don't care. They'll just run you over. So I try to limit my me like going into all these parking lots, whatever. I mean, really, all I go to is the grocery store, and that's what I do buy in person is groceries. That's probably what I buy the most in person. But that's really all I do is go grocery store, buy some clothes online, and that's about it. I'm really not a flashy guy. I will add more silver and copper stocks in the upcoming period. Yeah, I would too, and that's what I would definitely do that. How's whale oil doing? Seeing any price deflation as the Middle East gets volatile to Kathy Wood. So Kathy Wood back in 2020, 2021, she was just harping on oil never going up again. I have no idea what universe Kathy looks at this world from. Her paradigm is so different than mine. It is unbelievable. Her opinion is important example of the price deflation associated with technology-enabled innovation like battery pack systems. The Fed continues to base its decisions on lagging indicators, AI, blockchain technology, robotics, and multi-omics sequencing will add to deflationary pressures. So technology, all it does is improve the efficiency of everything. It does not solve a physics problem where you don't have enough minerals in the ground. It doesn't create minerals from nothing. It is not the GOD technology, but I don't know. I don't know what she's doing. I don't know if she's on drugs. I don't know if she's. I don't know. Most of the stuff she says does not make any sense to me. I don't understand it because what I consider to be like basic knowledge to some degree, like oil's used in everything. To me, that's kind of basic knowledge from all the stuff that I've learned, and I don't know for her to understand that. I don't understand. This is a controversial one. Do you think some people are better than others? Yes, I do. But it depends on what category you break them up into. It depends what they're better at. Everyone's better at something. So then you could say, well, this one's better than the other person at doing X or at doing Y. So yes, there are some people that are better than others at doing certain things. There are things that I cannot do that Terry Tao can do, who's got an IQ of like 200 and something. The dude's a freaking genius. He can do things that a whole bunch of other people can't do, and he's better at doing it than the majority of the world. And we need those people. We need better people, so to speak. This guy's back in fashion. Win Moon for uranium. I love it. Trucking employment to 1990 levels, falling off a cliff. Could there be a recession coming up? It sure looks like it. Sure looks like something is slowing down. So a lot of these times, that's when gold really kicked it into gear. I like it. Renting is now cheapest. It's been relative to home ownership since at least 2015. So this is your mortgage payment with 10% down and the median rent. And monthly mortgage payments on typical U.S. homes are more expensive than rent. Well, yeah, this is like the cheapest time in history is the early 2010s and 15s. Then you can see the interest rates popped up, and that's what caused or drove the mortgage payment. But people are going to have to put more than 10% down. But I also wouldn't want to be on the rent side. Rent has always been a rough area. And the rent for like a bigger house is way more than this. So, of course, this is World War III. Just look at what's going on in the U.S. bond market. Worst crashed in 1779, and empire is collapsing. This stuff doesn't happen every 80 years. It happens once in 250 years and always ended with big wars. Ray Dalio now believes there's a 50% chance of World War III erupting as the Israel-Hamas conflict spreads. What are your thoughts? I agree. I think it's going to spread. That's what I think. This is an intriguing chart. Silver to treasury ratios starting to break out. And I think as people go to war and as we print more money, real assets are going to be completely mispriced where they are today. So they're going to go way up. And there's going to be a shift into real things. Big time. But that's where I'm going to end it, guys. That's where I'm going to end it. That's all I've got for today. Give me a thumb up. Subscribe to the channel. But yeah, that's all I've got for today. So we'll catch you next time. This is Finding Value.